Sure. Hey, Carl, good to see you as always. Yeah, there's a lot of facets to the Amazon story. I mean, I think first at a high level, we have to remember where we've come from and where we're going. They've built out a lot of capacity in the warehouse network the last 2 years, arguably overcapacity. And now as retail continues to grow double digits and seems to be accelerating into the holiday season, they're growing into that overcapacity. And so you're getting more units flowing over all of their warehouses, more units fulfilled by all of their workers and their employees that they've hired over the last 2 years. And so that drives leverage in the underlying retail unit economics. And then on top of that, yeah, the ad business is a big piece of this story. You know, the incremental margins on the advertising dollars are incredibly high relative to retail. And what they've done a great job on the advertising business is they've built up a large ad business on the core Amazon.com website. So merchants can pay for ads to have their items show up at the top of the fold when people search for toilet paper or Bounty, et cetera. And now they're expanding that advertising business into new platforms such as connected TV. And the NFL and Thursday Night Football with Amazon is sort of the next big test we're going to have as to what type of connected TV advertising business Amazon is actually going to be able to build out over the next couple of years.
That's interesting. So if for those who are predicting or awaiting a return in margin leverage, is the Q4 guide going to be the key?
Yeah, the Q4 guide is really the next catalyst for this stock and this company, because there's a lot of volume flowing over the platform when it comes to the fourth quarter. And when you get just because you're going to be flowing so many more units over those square feet and over all those fulfillment center workers, which drives higher utilization and ultimately more profitability for the entire company.
Hey, Brian, it's Deirdre. Amazon loves to talk about putting the customer satisfaction, customer joy at the center of everything they do and create. I wonder, do they risk worsening the Prime experience if we start to see ads on Thursday Night Football, Prime Video? How is the company going to balance that?
Yeah, it's a good question. I think they'll take a pretty pragmatic approach. I mean, in some cases, you know, with the NFL, I think consumers in general are quite used to the idea of there's going to be ads during an NFL football game. So I don't think that's going to have a lot of pushback at all for people who want to watch the Chiefs versus the Chargers on Thursday night, as an example. I think the other advertising across Prime Video and connected TV, they'll go slowly. You know, you're going to sort of have two litmus tests being run now publicly, where you're going to have both Netflix and Amazon slowly testing advertising across their connected TV product. And I think that's where you're going to see a really slow and disciplined and data-driven approach for how quickly they push ad load, what's the reaction to engagement, and how does it improve the overall lifetime value of the customers. Because for Amazon up to this point on Prime Video, which we think they're going to spend $16 billion on content this year, what they've learned from it is that the more video content they have for Prime members, it leads to higher Prime gross ads.
Of Amazon's business lines, which do you expect to fare the best and the worst? And I'm talking Amazon's own retail, its third-party retail, its ad business, AWS, et cetera.
Yeah, it's a great question. I mean, it depends on what type of recession we have. Given how large the high-end consumers are within Amazon's overall ecosystem and the Prime sub-base, spending is held on better. However, if we do have a recession where even middle and higher income consumers are pulling back on spend and you have consumer weakness, the retail business would be at risk. And then argue for retail. On the AWS side, you know, we've sort of heard about consistent deceleration, sort of drip, drip, drip slowing in the pace at which enterprise cloud deals are getting done. And in the back half, slowing again next year. But I think it sort of comes down to, in this case, what is the slope of that deceleration? If you have a larger enterprise pullback, then you have AWS risk. So it's been an interesting, you know, downturn to study, because the consumers held up in some areas, has pulled back in other areas, and the enterprise is just sort of slowing, spending at a slower rate. And I think where we end up in 23 kind of comes down to the health of the high-end consumer and the slope of enterprise spending growth.
Yeah, it's amazing what a proxy, what a clean proxy the company is for the U.S. economy. Just amazing. I guess at that kind of scale, it wouldn't surprise you. Brian, appreciate it. Fascinating note. Coming weeks should be interesting. Brian Nowak, Morgan Stanley.